And good day, everyone. Thanks so much for joining us. Today, we're going to be discussing all things single-family rental. We've put together a fantastic panel today. My name is Jeffrey Tesh. I'm CEO of RCN Capital. And really what we want to do today for you folks is have a forward-looking conversation on rental all the way through investment, acquisition, management, and disposition. Today's panel is full of all-stars. I'm going to start with Michael. Michael, please introduce yourself, a little bit about yourself and your company, and great to have you on board today.
Yeah, thank you, Jeff, and appreciate you taking the charge and moderating again. And thank you, everybody who's on the panel and attending and listening in. Really appreciate your time today. My name is Michael Finch. I'm a principal founder of SFRhub Advisors, which is our commercial brokerage that's 100% focused on single-family investment portfolios and new construction build-to-rent portfolios. Also a partner in SFRhub.com. That is a data and valuation and technology platform that really powers our brokerage and enables us to analyze and evaluate portfolios efficiently and quickly to the benefit of our buyers and sellers. We do a lot of consulting out of that company as well in the build-to-rent space, and some for note buyers looking to understand the collateral behind what they're going to be buying and purchasing. But those are our two main companies that we'll be focusing on today, and from my perspective in this conversation. So look forward to speaking, and I appreciate everybody's time.
Yeah, it's going to be great, Michael. You have a commodity right now on your platform that is in unbelievable demand. Can't wait to hear more from you. Scott, great to see you again. A little bit about yourself and your company.
You bet. Thank you, Jeff. Great to be with everybody. Excited to join this panel. My name's Scott Saunders, and I'm a Senior Vice President with Asset Preservation. We're a national qualified intermediary, so we specialize in 1031 exchanges all over the country. And this topic is just very relevant because we've seen such an increase in investors looking for single-family rentals, build to rent. So looking forward to joining all the panelists, and thank you.
That's great, Scott. Next up, we're going to go right to Chris Dorn from RCN Capital. Chris, what's cooking in the finance world?
Hey, Jeff. So I'm Chris Dorn, RCN Capital Sales Manager. Here at RCN, we are busier than we've ever been. A lot of that is driven by the 1 to 4 family rental space that we're going to be talking about a lot today. Huge numbers of increase there. It was a good program before COVID. And even since COVID, it has not slowed down in the least bit. And we also do 1 to 4 family fix and flip financing. We'll do some financing on multifamilies as well. And really looking forward to working with the panelists here today to help educate the viewers. It's really a great team of panelists we have today, and everybody that's really going to be able to kind of touch on different points in the process and different point of the perspective, whether it be from a property seller, an investor, a qualified intermediary, or even the lender's perspective, what have you. We'll get a lot of different things today, so very excited for the panel.
Fantastic. Next up, Mahesh, you're out there aggregating. Tell me about yourself.
Thank you, Jeff. Number one, thank you to everybody to joining the call today, and particularly to RCN for facilitating the panel. We appreciate you guys doing that. A lot of hard work going on in the background. So thank you very much for doing that. I'm the founder and CEO of ILE Homes. So we are an investor aggregator of single-family homes. We have always liked and believed in the sector. We had been waiting for the right time to jump into the market. So this, single-family homes is probably the most reliable, the most predictable, and the most safest investment in real estate. And our idea is to espouse the theory amongst investors and socialize the opportunity to invest in this sector. Thank you very much for having me today.
That's fantastic. Thanks so much. And then finally, Don, good to see you again. What's going on in your in the management world?
Yeah, so quick bit about myself. My background's in really founding companies in the real estate tech space, and the last one was a company called Home Union, which allowed investors to invest remotely into single-family real estate around the country in a sort of stock market data-driven way. The company was acquired by Mynd Property Management a couple of years ago. I run the investor services business, SVP of that business at Mynd. Mind's got a pretty unique pedigree. It's founded by two individuals, Doug Bryan, Colin Wheel, who actually took the first single-family REIT public and then merged it. It was called Waypoint. They merged it with Colony, and then it got to Invitation Homes. And when they came out, the feeling was a ginormous pain in the butt was really managing properties for single-family investors. And so they put together a tech-forward property management company, which is invested quite a bit in technology to make property management efficient and scalable. So company is in 22 locations, manages over 7,000 properties, and it's sort of a virtuous cycle of end-to-end from acquisition to getting financing to not the kind you guys do here, but the regular Fannie Freddie financing, to getting insurance on your property, to getting the management of your property, and then actually selling the property when you're ready to sell it. So it's a full investment life cycle. And it's in the single family space with both retail and institutional investors.
Fantastic. Thanks so much, Don. So we are going to do a couple of polls today, 2 or 3. We'll see how much we have time for. First poll, Erica, we can put that up when you're ready. We're just going to take a bit of a flavor of who's on the call today. And we're going to look for developers, investors, brokers, property manager. So just respond if you have a chance. And Erica will tabulate that and hopefully be able to share it with us as we go along today. In addition, as always, there is the ability to ask questions. We're going to have a chat box. If you look on your screen, you see the queue for the questions. Do not hesitate to go ahead and put some questions in there. We're going to attempt to leave some time at the end to answer some of those with all of the panelists today. So, Michael, as this 2020 rolling into 2021 marketplace has evolved, we're seeing a tremendous number of folks translating or transitioning from multifamily into single family aggregation. Now, I want to be mindful of the folks that are attending today. Maybe not only talk about what you're seeing, but maybe more importantly, what kind of mindset those investors need to have making that transition.
Yeah, that's a great question, and we are clearly seeing that as well. I think Mahesh said it quite poignantly. The commercial world, and we're SVN, is a commercial brokerage. We're the 6th largest in the world, and we've been trying to educate the commercial investors on this space for years. We've been doing it successfully, but COVID has just accelerated the acceptance of this asset class because, like everyone on the line that's been in the space and everybody that's a panelist here knows, this is the most risk mitigated and stable asset class in the country and has been for a very, very long time. It was just a lack of institutional recognition, I think is the right way to say it. And that's been squashed and proven to be, we are proven now to be a real institutional asset class. So you've got the big multifamily guys coming in, and a lot of them are looking at the build for rent space, but there is a big chunk of them that are also still looking at the multifamily or the scattered home portfolio space, because you've got groups such as yourself that can do the loans. You've got groups like mine that can manage these with arguably better technology than the multifamily property managers have. I think there's some catching up to do on that side. And it's again, like Mahesh, I can't say it any better than Mahesh. It is stable, it's risk mitigated. There's multiple exit strategies, and there's there's longer price appreciation in the long game, as opposed to just solely trading on cap rates like most commercial real estate assets do.
So, that's really a great bullet point for investors to think about, right? not just what your return on investment is going to be today, but
Mhm.
from an appreciation standpoint, what kind of data maybe you could share with the listeners today on what investors making that transition from multi to SFR should be thinking about in the long term?
Yeah, I mean, if you're a long-term holder, it's, and you're buying, you always want to buy right. But even if you're buying high, arguably today, home prices are significantly higher than they were 5 years ago. Rents in our markets, in the single family market, have also followed suit and have been quite aggressive in growth, which we now have not seen in multifamily. So you've got, for COVID, for example, COVID happened, or the last recession happened in 2008. Rents stabilized back then and arguably started growing because the demand for rental homes was growing when people were losing their homes. Now we have a low supply of homes driving the price up, but it's also driving the rent growth. Now, if there's some market correction, there may be a home price value decline temporarily, but the rental market will stay strong because people aren't going to buy homes like catching a falling knife, so they're going to continue renting. So your rental demand will continue to grow, even if your valuation temporarily is declining. But if you're buying in the right markets and in growth markets, or in the growth trajectory within a particular market, over 5, 10, 15, 20 years, not only will your rent be stable and continued likely to grow, but the overall value of your home should grow over time, at a higher pace comparatively to other commercial real estate asset classes.
Yeah, and I think that's another point that we can expand on, which is MSA migration, right?
Mm-hmm.
Sophisticators today, I know we deal with them all the time at RCN. They're not buying where they live typically. So what are you seeing from portfolio aggregators out there? Where are the markets? Not only the primary, we're starting to see more tertiary markets really come on. What are you seeing?
I mean, we're seeing all of it. We've got deals in escrow from Phoenix to Baltimore to Tampa. We're starting to negotiate a deal that we've got listed in the Quad Cities right now. I've got a couple of buyers looking at that. One buyer happens to be local. The other one happens to be from Florida. We're negotiating a deal in Northwest Arkansas from a guy out of Seattle. So, a majority of the portfolio buyers are typically not local, at least from what we're seeing. And reason being is because of groups, like Mynd, that can assist them, and they can find a trusted source to manage their portfolios from afar.
Yeah, that's a very fair point. And let me just pivot to Don on that point. Don, are you seeing the investors not only not buying in their local area, but more importantly, are they venturing out into some of these tertiary markets?
Yeah, I think first of all, remote is, as Michael said here, it's enabled by property management. I mean, when you're in a remote market, it's like I can't fly there all the time to see what my portfolio is doing. So an enabler is finding a trusted property management like Mynd or someone else to manage the property. The other part about this is, the money tends to be on the coasts, and the coasts are kind of like Apple stock, right? You've got to buy on the high, you've got to have a higher quantum of investment, and you got to hope that it goes up even more, and you're not going to see a lot of dividends, right? So people that are looking at yields are going to go to markets in the Midwest and the Southeast and places like Atlanta, Charlotte, in Florida, where they're going to find better yields. By the way, as Michael said, those are compressing because there's a lack of inventory and prices are rising. And although rents are rising, the prices are not rising. Rents are not rising as fast as prices are rising right now, just because of the sheer lack of inventory. So when you look at this, you kind of look at this as a bond with an equity kicker, right? I mean, that's what this investment is. It's you get a certain cash flow and a yield, and then at the end of it, you see a certain appreciation. So So I think there are two things happening with investors. One is, yes, they are now looking at certain tertiary markets because they're finding portfolios there that make sense. So you're looking at places like Nashville and others that are beginning to get some motion. If you even look at places like Oklahoma City, which we are not in today, but there's a fair amount of properties being managed in that kind of a space. So that's one phenomena that we're seeing. The other thing is there's now, I mean, I'm sure Michael's talking to his buyers about this, is you've got to get the conversation a little bit more towards total return. I mean, in the past, it was yield, 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 yield. That's why I'm here. It's non-correlated to stock market. But now, we were, looking at a property. There was an investor on our platform that bought a property at, I want to say, end of 2019, and he'd seen a $150,000 or $200,000 depreciation by the beginning of 2021. There's another property in Austin that had 86 offers on it, 86 for a single quad. So that's the normal we live in. So you either got to, recalibrate your expectations and say, I'm going to look at this overall return a little bit differently, or you got to go hunting in some secondary, tertiary markets before people catch up to you there. I mean, that's just where it is. And I think, what Michael's doing, I mean, that he's probably seeing a ton of demand because a couple of other things, if I may just, the COVID situation, the house, office, all of these things, right? So people are going into suburbia and a lot of them are renting. So the commercial demand that has fallen off from office space, from gyms and others are actually getting channeled into single family real estate. So if my money was going to be in office buildings and retail, I got to do something with my money today. And single family is a large, there's a large swath of assets, and there's a structural transformation going on. I was talking to a friend of mine in Silicon Valley. He was saying I was paying. He was on a call with me, and I saw all his gym equipment at the back, and I said, "What's that?" And he's saying I was paying, this much money for my gym every month. Now I just brought it here. I get on and I watch the TV and I do my stuff. I don't think I'm going to go back to the gym again. Now, that's a structural change, right? The same thing about people working in their offices at home. So you need more single-family homes in suburbia that people are going to, which in turn is driving investors to the asset class away from commercial. So it's sort of a perfect virtuous situation for the asset class, and it would be all great if there was inventory.
Sure. Yeah,
I would add one more point, Jeff, in that, we're, and you guys can comment on this better, you and Chris, but what else is evolving for aggregators such as Mahesh or, the other buyers that we're working with, whether they buy, a portfolio in MSAs to aggregate to what they already own, or they're attacking, one-offs to aggregate portfolios. The financing environment is changing in the marketplace as well, right? And more lenders are looking at the income approach as opposed to the old school traditional. You got to, what is the actual appraised residential value of each home, because this is becoming institutionalized and it is becoming recognized as a commercial asset class. And like multifamily, nobody says what is the value of that 1-bedroom unit or that 2-bedroom unit. It is what is the income that's producing, and now we're starting to see that. So from an aggregation and disposition standpoint and a return standpoint, as the space continues to mature, it'll be, I think, less and less about what the value is of each home in your 50-home portfolio, but more what is somebody willing to pay for that cash flow. And that's when you can actually sell a portfolio of homes more than what the actual individual price per home is, because somebody is buying the return, just like every other commercial real estate asset class out there.
Sure. It becomes a conversation about a financial transaction and less about exactly, what that underlying value is. And yeah, it makes a ton of sense. Before I get to Scott, Michael, maybe throw out one marketplace that investors today are starting to look at that has surprised you.
Oh, that's a good question. Oh gosh.
And you can tell folks we don't pre-do this, right? I'm putting Michael on the spot here.
Yeah, no, that is good. I'm trying to think of what surprised me. I I can't say I've been surprised yet. I mean, we're a big believer in the market in general, and I think if you're buying single family homes, you're going to be in a safe position. I would be surprised if somebody told me they bought a portfolio in San Francisco or New York City, but I haven't.
Yeah.
I guess I can't answer that question. It's a great question.
Yeah,
I'll-
no, and it's interesting because we're starting to see some of the aggregation in traditional, outside of those traditional smile states, right?
Mhm.
But it's becoming less and less of a surprise now. When we see portfolios of homes being aggregated in northern Ohio, right? Like you wouldn't think of that, but there's so much workforce housing there that can be aggregated with a real nice return. It's amazing,
Yeah.
some of the things that we're seeing.
I mean, we didn't get this portfolio sold, but we had a large 290 home portfolio in Lima, Ohio. And, I guess I was surprised at the amount of interest that we got. We were in escrow 3 times, and it was unfortunately the owner of the portfolio, who had been doing it kind of back of the hand for 30 years, had just he didn't have any records. So the buyers just kept running into the same issues. Well, how do we get to the bottom of of what's happening here? And so there were some challenges with selling the deal, but it's a 50,000 population market that's not declining, that's not growing, but has a stable rental base. I mean, I guess I was surprised at the level of interest we got in that market, but not surprised that there was interest.
Yeah, that's interesting, and that's definitely a community that is not on my radar. So that's interesting. So Scott, let's transition to you. We've been talking about aggregating the availability of homes. Lots of folks today own assets, but want to continue to build their portfolio. And at the end of the day, 1031 is certainly the way to defer taxes, but is today what we're going to see 6 months from now? I mean, we do have a new administration in. Maybe your thoughts on that.
Yeah, be happy to share my thoughts. I mean, 1031 is a powerful tool for people to go. We talked to somebody just yesterday selling a home in San Jose, buying 10 single family rentals in the Memphis market. So they're doing that with the 1031 exchange. Otherwise, they'd be absolutely clobbered with the taxes. And interestingly enough, this year, believe it or not, it's the 100-year anniversary of 1031 exchanges. So they've been in the code for 100 years now, through all sorts of administrations, through economic recoveries and downturns. So they've been around a long, long time. Obviously, the origins of 1031 started more agricultural, right? And then it's kind of evolved into commercial and other things. So in the marketplace for the last probably 6 months or so, we've been hearing, you mentioned that time frame, we've been hearing a lot of rumors. There have been articles out about the demise of Section 1031. Or 1031's going away. Our 1031's going to go away for anybody under 400,000. So what we had is, when President Biden was running for office, he came out with some tax proposals. And I want to be really clear, this isn't a partisan issue, right? A lot of different politicians have looked at 1031 and said, could we capture that revenue now that's being deferred? Could we bring that in as additional revenue to pay for programs? What happened was Biden came out with a tax plan, and in his tax plan, he had some new spending, about $775 billion of new spending for elder care and then for child care. To help pay for that, he proposed getting rid of Section 1031. So that would be part of the pay for. Now, when I say part of it, when you look at the numbers, he's looking at about a $775 billion of new spending over 10 years. 1031 with the Joint Committee on Taxation predicts something like maybe $80 billion of additional revenue. So it's not even really close to getting the revenues to balance the new spending. But as a result of that proposal, a lot of people have been wondering, and we get questions, we're fielding questions daily. You know, are 1031s going to be around? Do we need to do one right away? So there's a lot of uncertainty right now in the marketplace about 1031 exchanges. It's kind of been a standby that people have been using. You know, in fact, a lot of the commercial investors started with single family rentals, right? They buy a rental or two and go into two and a fourplex and an apartment complex, and they kind of move up. And now some of those same people are coming back and they're going into portfolios like Michael has, where they'll buy a group of them because they like the asset class. So 1031 has just been such a critical part of the marketplace, allowing people to redeploy into better performing properties and defer their taxes. Remember, they're not tax free, right? They're just postponing. That gain follows them from one asset to another, but it does allow them to use all that gross purchasing power to leverage up and to buy bigger and bigger portfolios. So it's been a real powerful tool. And right now, I would say there is uncertainty because of that proposal that came out, you know, as kind of a campaign proposal. So remember, when you're running for office, everybody has grandiose ideas. When you're actually in office, you then have a little bit more narrower bandwidth. You got to navigate. You kind of have the fantasy land of a proposal, and then you got the reality. And I think that's, and I can speak to that a little bit, but I think that's what the Biden administration now is facing, is kind of how do we implement tax policy with a Congress that has a really tight margin right now.
So as an investor, maybe let's take the investor who's done a great job aggregating properties, and they're looking to dip their toe into that 1031. What is the advice that you give to them when they start thinking about that to make that move that maybe they've never made before?
You know, I would say in the market, I think as we're all aware on this panel, assets are turning over very, very quickly today. You know, if it's priced right, it doesn't sit on the market for very long at all. So my input to an investor today is, if you're looking to maybe list your investment property, start looking at what you want to buy at the same time. When you set up an exchange, you close, you have 45 days to identify. Don't wait for that month and a half time window. Start looking now for what you want to buy. So that's where, you know, the SFRhub is a great tool, because you can look online and see what's out there now that might work. Or working with a broker and saying, I want to buy in this marketplace. We're definitely seeing a lot of investors, as was mentioned earlier, go from the equity rich coast and go to other areas, whether it's the Southeast or the Midwest. So now you're working with new brokers that you've never worked with, right? You might have a relationship with somebody in your backyard. Now you're branching out. Begin finding what you want to buy right away. It's critical. And I'll tell you what, I'll confess, I'm doing an exchange right now. I sold on Michael's market on Monday, an asset, and I already had to line up. I'm buying 5 replacement properties, so I'm buying single family rentals. I lined them up before I closed on my sale, because I didn't want to have that time pressure. So that would be my input. Make sure you either have them under contract or you're feeling very good that you're negotiating with the seller, because that time deadline goes by really, really fast today.
So Michael, I would think you're seeing this in a real world situation.
Yeah, actually, I mean, we've got a seller in Florida who I think will be listing his properties here soon, and he's, you know, north of Miami, but you know, nice area. He's got, you know, nice vintage quality homes, and he's identifying, or he's looking at our portfolio in the Quad Cities, which is you know, a higher yielding. It's going to take a little more hands-on work, but he's not afraid of that. But yeah, he's looking to us to help, you know, sell his portfolio and identify the one in the Quad Cities that we have listed now, that we have a few people looking at. And then to Scott's point, and some advice too, you know, we were working with another 1031 buyer out of Pennsylvania this year, and he had put in his contract, which was significant. He had a large 1031, but he had negotiated a disposition of his portfolio, which happened to not to be single family homes, but he was looking to buy single family homes. he had a portfolio of industrial, and he got his buyer to agree to not close until he identified 3 properties, so that he could immediately close and simultaneously go after the 3 properties that he was identifying. So another, not all buyers are going to be that patient and be open to that, but it's something as a seller you can try to negotiate.
Yeah, it makes a lot of sense. Scott, maybe, and just in the interest of providing information for folks, cautionary tales of what happens if you really come up against that deadline. Because I think, to your point, investors need to be really thoughtful about planning out their strategy. Maybe a real world story of what happens if you are not prudent in time management making these exchanges.
Well, unfortunately, I've got lots of real world examples there, but the net is, if you can't accomplish an exchange, if you can't identify something within that 45-day window and then close within 135 days after, you're going to have a certain tax hit. And that's really the reality of it, is you're going to then face all of the taxes in a fully taxable sale. People are surprised to find out just how high that tax hit is going to be. You've got depreciation recapture at 25%, federal capital gain at 15 or 20%, net investment income for many investors of 3.8%. And then you got to add to it state taxes. California, that's 13.3%. And I'll tell you, with all that we've been through with the virus, a lot of states now are looking to increase their tax rates. So I think that's happening proposed in Minnesota, New York. So you got to add all 4 levels of taxes. And unfortunately, you're going to find that you're paying a whole lot of money over to the government. That depreciation recapture, particularly for people that have owned assets for 20, 30 years, it's a really big tax hit. So I would say it's critical to work on that replacement property right at the very beginning. And then the second one would be throw in a backup or 2, right? If you've got all your eggs in one basket, you might want to identify a backup property or 2 so that if your first doesn't work out, you got somewhere to go. That would be another tip.
Yeah, it makes a ton of sense. And, Chris, I know at RCN, we've been seeing these 1031 exchanges. We've been seeing a lot of different trends going on, really since the fall of 2020. Things are changing, a number of properties being aggregated, leverage. What is some of your real world feedback for the investors on this call today as to what's happening in the marketplace on the finance end?
Sure, great question. So on the finance end, what we're really seeing over the last, we'll literally say 12 months since COVID, basically, is that, since about summer of last year, when the marketplace started to get a little bit more comfort level and you saw that activity start to rise again, we saw from the lender space that, competition has continued to drive down the cheap money. So we're seeing lower rates for these long-term loans. And we're also seeing more aggressive guidelines and terms come about from the lenders as they compete with each other for the customer's business in this space. There's a lot more, competition between lenders to go after these investors as well. So that's been beneficial to the investor side, so they can get cheaper financing options and more aggressive terms. And what we're seeing for the investor side is a real rise in exactly what we've been talking about, this aggregation where, people aren't just buying, one-off properties as much anymore. We're really starting to see them take a more focused strategy of, identifying prime markets for these investments and buying multiple properties and really building out portfolios more so than they used to. For the individual investor who's buying maybe more one-off properties, we're seeing them do that more through a value-add approach where they're probably coming to us for a purchase and rehab loan first, and then establishing a tenant in the property, and then exiting with a refinance and then repeating. So we have a couple of different approaches that we see from the investors, which have been, highlighted by the other panelists as well. But, there's a lot of appetite in the lending space for these types of properties to be financed. And, at RCN, it's become a growing part of our portfolio, whereas originally we started out, primarily as a fix and flip investor source. We're now, covering a lot of different avenues with the product mix that we have. and that 30-year rental portfolio and single asset loan has continued to be a bigger and bigger portion of our portfolio.
Yeah, so let's talk about that, because I think today, with the mix of investors we have, and Erica, feel free to put up the next question, which are what asset types are investors interested in this year? I think this will segue good to this particular point, Chris, which is, we've seen a transition from investors beginning to aggregate single family properties as, maybe a retirement, to transitioning into this is their business, and they want to build a business around single family asset aggregation. Maybe some tips for the investors on the call today as to what they need to think about from single family, and take this from the finance perspective, what they need to think about from financing single asset aggregation to thinking about just going out and straight up buying portfolios. From a finance standpoint, what do the investors on the call today need to think about?
Sure. Well, for anybody who's looking at the, rental portfolio market or even a single asset, what you're really looking for, obviously, is, a good positive cash flow. For the single family property that's out there that people are going to buy as a rental, you can, the reason why we're talking about doing it in these certain markets, like you see in the, the Sun Belt, the Southeast, what have you, is because those are areas where you have traditionally lower taxes for the property, has a lower cost of ownership and holding there for the investors. So the real expense of the loan itself really more becomes just, the amount that you're borrowing and paying back the principal and interest, and you'll have marginal costs for taxes and insurance. And that's what makes those properties so attractive for cash flow opportunities. Whereas we talked about before, places like the Northeast or in the West Coast, where you have those high property values and those high property taxes, it can be very difficult to see positive cash flow on those properties without being at a much lower LTV, loan to value on those. Whereas we see, for people who are buying in these markets, we've mentioned a few of them, like Atlanta was one that came up before, lower tax base for the properties, better cash flow opportunity there. And that creates a real multiplier effect as you build out a portfolio in some of these markets. And using a group like Mynd Management, like from down there, who can manage these properties, we're seeing a ton of investors who are in these Northeastern markets or West Coast markets. And, they're investing now in these, more Sunbelty kind of southeastern parts of the country where those, holding costs are less expensive for them. And from a lender's perspective, for us to see that, increased cash flow because your costs are lower, really makes it easier to qualify those deals. And, the price points in certain markets in the country, whereas you have in the Northeast, New Jersey is one of the harder ones we see. We get a lot of business in New Jersey, but the single families there, because the property taxes can be so high, we see them all the time, $15,000, $20,000 a year for property taxes. That's a lot of money. That's going to kill your cash flow. And so we're seeing less investors in that space for single family rental, but we will still see, the fix and flip investors there. The challenge for the fix and flip investor these days is, what we've been talking about before too, is inventory. It's much harder to find the inventory that's out there. We do anticipate that, in the coming year, we're going to see some foreclosure volume start to work its way through the system. As people inevitably will be losing their homes during the COVID times, and that will spur some additional, purchase and rehab opportunities. But I think if you're in these markets where you do have a low cost of holding these properties for taxes and insurance purposes, you're more likely to see that a lot of investors turn to those as a rental investment for them. And then, as I think it was Michael mentioned before, over a 5-10 year period, if you're not interested in, having that strategy for yourself, you're probably going to have an opportunity to still cash out on those, sell them off, call Scott so you don't have the tax implications. But you can still sell them off and recoup that equity value that you built into that property over time, because the high demand is going to continue to drive those prices up. And in the meantime, you're getting great returns on your cash flow. It's a win-win situation for a lot of investors who should be looking at these properties in multiple ways, right? You should analyze all these investment properties as, how does this work if I'm holding this as a rental? What does my cash flow look like? But if your strategy is potentially to rehab and sell, what does my strategy look like there, and what kind of returns am I looking at? And does it make more sense maybe to hold this as a rental for a few years and then cash out. So we're seeing that from a few different investors now, but there's definitely been a shift in the market towards that rental investment. And for us as lenders, we're really looking to see that that cash flow is there and that it makes sense and that we have a good investment value in that property. And then, for a lot of lenders, for this type of product, we're not interested in individual income for these borrowers. We're really interested in the cash flow of the property itself and what kind of credit score they have as an individual borrower. And that's really what's going to drive what we can do on these files and how high of the leverage we'd be willing to take.
No, that's well said. And, this is a good transition right to you, Mahesh, which is, you're out there, you're boots on the ground, you're aggregating homes. Maybe, at first talk a little bit about what organization that you've built and how investors on the call today can really learn from you on some best practices on how you've built your organization.
Yeah, thank you. First I want to kind of lay out our investment thesis. Why are we in this business at all, right? So I feel there's 3 or 4 large demographic or macroeconomic trends happening that it fosters the investment in the SFR space. Number one, the millennials, as they grow older, regardless of what age they are in, when they get a partner, they don't want to stay in an apartment anymore. They want to be staying in a home. And the chance of their ability to afford a home today is much more constrained, primarily because of the other debt they have on the balance sheet. The number of multifamily apartments which have 3 bedrooms and over is less than 2% of the total inventory of multifamily apartments. So that in and by itself is a big demand for single family homes. And this was happening even before the pandemic. The pandemic essentially accelerated the trend, right? The second mega trend that's happening is baby boomers, where the single largest asset on the balance sheet is their home. And what they're doing is they're monetizing the asset and prefer to rent and cash out of the home as opposed to continuing to stay in the home. So that is the other trend that is happening. Number 3, we all know with the incredible amount of stimulus that is coming to our economy, inflation is around the corner, right? We can, the Federal Reserve has overtly told us today that their inflation guidelines are going to be on 2% on average, which really means they're going to allow the inflation to creep up to 3% before clamping down on the interest rates. So that if you're in an inflationary environment, the best place to be is in hard asset, like single family homes. And the fourth trend that is happening that we all know, this is happening from a societal perspective, which is, and you see that in the original Biden administration campaign was increasing the minimum wage to $15. We believe that is going to cause an incredible amount of demand for middle class or homes in a 3-bedroom, 2-bath, because no matter which part of the economic ladder that we all belong to, if you follow Maslow's hierarchy of needs, shelter is a very important asset. And we all want to take care of our families, all want them to stay in a safe neighborhood. And there's going to be incredible demand from that sector of the economy because the disposable income going up in that particular segment of the economy is all tax-free because they're still below the tax threshold. And so they have more disposable income to spend, and they're going to spend it on renting because they don't have the affordability to buy homes. So that's why are we in the business? Those are the mega trends which allow us to be in the business. So now that we're in the business, what do we look at in order to build the organization? So I like to, I have very simple mind, so I like to think in terms of 3 or 3-legged stool. So our investment criteria is based on 3 different criteria. One, we have to have equity in the house when we buy it. That's very important. Number 2, the age of the asset. We have a certain threshold beyond which we are not going to buy an asset. We don't care how, what the bargain is, we're not going to buy it. And number 3 is the yield on it, the gross rental yield on the property. And the basic premise is that every property has to be cash flow positive when we buy it. We are not looking to subsidize the asset. Now, if you maintain all of those 3 criteria, how do we go into a market and actually execute on the strategy? So the strategy is also broken up into 3 pieces: acquisition, renovation, and management. So acquisition is what I just talked about, is the three criteria that we use to buy a property. The renovation piece is equally important because every property that we buy, almost 90% of the property that we buy, we renovate it. And we have to have a proper program to renovate the property. So we have institutional pricing. We know how much it's going to take to put a hardwood flooring or painting or a new HVAC, etc. And we have institutional relationship with mega retailers to get the Black Friday pricing all the time. So that allows us to save a lot of money on the renovation part. And then the property management, which is a key factor in the success of the portfolio, because unlike in multifamily, where the average tenure of the lease is about 14 months, in single family, it's 3.2 years. And if I can increase the longevity of the lease from 3.2 years to 5 years, my property becomes hugely profitable because I'm minimizing the turnover cost, right? So we are tenant focused, and everything that we do from a renovation perspective is to increase the longevity of the lease. And because the last thing we want to do is to roll a truck out to a tenant and for a plumbing issue or some minor issue, which is going to decrease the profitability of that property. So we are very focused and very laser focused on what we need to do in each and every property. And I think when I look at my portfolio overall, why is it that I'm assembling a portfolio? I mean, all of us have talked about the income potential of single family rentals, right? But there's an incredible amount of research. The San Francisco Federal Reserve has published a study that going back to 1870, all the way walking up to 2015, that single family has returned a better return than the stock market, almost 200 basis points better than the stock market in that time frame. The National Bureau of Economic Research published a study going back 35 years, and they said the average unlevered IRR on a single family asset is 9.3%. Mind you, 9.3% unlevered IRR, which is pretty incredible, which is much better. In the stock market, an average person looks for about 8% return. A pension fund in California looks for 8% return, but a single family asset has returned 9.3%. So the way we look at it is that income, underlying asset appreciation, and cap rate compression. Between those three factors, we feel that we can create a really healthy and attractive return to our investors. So that's kind of in my, laying out my theory, both on the investment side and also on why we are in the business at all.
Sure. So a couple things that I think would be helpful for the investors today, which is you had mentioned equity in the home on the purchase side, right? And you also mentioned 90% of the houses, you're improving them in some fashion. Maybe you could give the callers today a little bit of an idea on what you look for when you're acquiring that asset from an equity perspective. In other words, how right are you buying it, and how much of that right way to buy it is being made by the improvements that you expect to do to the home to build in that equity from day one?
Yeah, it's a good question. So I mean, so we use a metric called ARV. I think everybody in the business is familiar with this, which is called the after repair value or the retail value of the property if it's put on the market, right? And all of us know that any property that, if you go to look at Zillow and look at your home price, and the presumption is that your property is ready for sale. And we all know that in order to get a property ready for sale, you're going to spend anywhere from $12,000 to $15,000 to get the property. It's a painting or some level of renovation. In addition to that, I believe that you also have incurring the brokerage fee, et cetera, so there's a transaction cost involved in selling the house. Our premise is very simple. I mean, the wholesale market, if you were to look at it, 3 years ago, the rule of thumb was 75% of ARV minus renovation costs is the price that you pay. Obviously, the number keeps changing depending on demand and supply. Right now, I think you're probably lucky to do it at 85% of ARV minus repair because the supply is so constrained. So that's just the reality of the supply and demand issue. But I think that number will come back down later in the year. I think by the end of this year, I expect it to be more at 75% of ARV minus repair. So how do we make money? If I can renovate the property at less than the gap between the ARV and the purchase price, then I have a built-in equity on the property. For example, let's assume the property is worth $200,000, right? ARV, and then the repair cost is approximately, say, 30 grand. So technically, I'm supposed to buy it at 75 to 80% of $170,000, right? So I'm okay to pay a higher price because my renovation number is going to be much controllable. So if I can buy the asset at 185, including renovation, or 190, I have a $10,000 equity baked in to the purchase price. So if I'm using $50,000 to buy the property, there's a 20% return on equity on day one.
Yeah, and folks, I really hope you just listen to what Mahesh said, because it's so critical that that's how you're thinking when you're acquiring these assets. Now, not every asset that you're going to buy is going to need that renovations, but oftentimes, more often than not, and we see this all the time at RCN, is taking advantage of your entry point to make those renovations out of the gate will give you that ROI for years to come. I mean, it's really well said. And Don, I want to transition to you now, because I know from a management perspective, a lot has changed since COVID, but data doesn't change, right? Maybe talk a little bit about what you're seeing from a management perspective with data and how investors today are using it to their advantage.
So when you're doing what Mahesh is doing, which is he's buying, he's renovating, and doing all of those, but when you look at a retail investor that doesn't quite have the sophistication necessarily of doing all that upfront of fix and flip, the rent is the sort of the cash flow engine, right, of that particular property. You go off on the rent and you're completely sideways. We talked about taxes. There are certain jurisdictions where the investment taxes are quite a bit different than the homeowner taxes. So we model those, and you got to model those because your monthly cash flow changes based on whether you're a homeowner or an investor. So the data aspect of this is really understanding, if the rent is the rent, whether you're going to get it based on what's being said, because you don't know it if it's a vacant property till you actually get the rent. And the difference with being a property manager that's actually having to rent the property versus just sell the property is we are on the hook for renting it at a certain price. So we can't come up with a number that we can rent it for. And the constant pull and push between two things is, one is, if we make that property a Taj Mahal and you can get the rent, but the investor is paying a lot of money to renovate it if they're buying it. On the other hand, if they don't do the minimum, they can't optimize for the rent. So there is this optimization between how much you put into the property and what you're going to get. And I think because we have an investment platform and we're also a property management company, mainly that's our central core, we're able to take both of those and optimize it and give the investor a proper view before they actually pull the trigger on the property. And this kind of happens to us often, is an investor is going to come to us saying, I'm going to buy this property and here's what my rent's going to be and I want you to rent it. And we'll do a little due diligence and we'll say, we can't rent it for that, what you've been told you can rent it for, because they may be buying it from some other place. And that often causes the investor to pivot and say, okay, then I'm going to get out of that, help me buy something else, or they go buy something else, because the moment of the truth is the rent. And I think we said this earlier, the one other aspect of real estate that we didn't talk about here that's negative correlation to the stock market. I mean, we've got all these other things, but it does have a completely negative correlation. We track this over 30 to 40 years, and it goes in reverse directions. Even when the market takes a dive, it holds up. So people come here to diversify. People come here for a long-term hold. And so the ups and downs of a market over a short period of time, I think we said that a renter stays there for a long time. An average investor, I think, holds it for 7 years. So the overall maintenance cost and the rent becomes very critical towards the health of that property versus what the short-term fluctuations do. If I'm a retail investor and the market's going up and I paid $5 grand more for it, so be it. I'm not flipping it tomorrow. I mean, over the long haul, it's going to take care of it. So That part of the data, and the other part that becomes very critical is real estate's hyper-local. So your neighborhood, what neighborhood, Dallas is a city, Atlanta is a metro, but real estate changes drastically from neighborhood to neighborhood. We track about 270,000 neighborhoods in the country, and we rate every neighborhood from A through D from an investability perspective. So when an investor goes in and wants to buy something in a neighborhood, they can look at the comps, they can understand the profile of the renter, they can look at what that neighborhood has done over a period of time. The one thing we can't do with a house is like a car, right? If we both have a 19 or 2015 Honda Accord, and that has been repaired a certain way, and all those repairs are public, then we know what the difference between those two cars are. But two 2015 vintage properties in the same neighborhood can be completely different, and it's impossible to model that on the outside before going in. So part of this hyper-local piece is you have the data and you support it with your local property management resources, so you can give them the moment of truth and say, this is what it's going to take once you're in on this property, this is what it's going to rent for, and here's how much it's going to take to do it. So that the neighborhood data, I think, becomes very critical. A lot of people are out there saying, hey, what's appreciation going to be? What's rent growth going to be? I think those are important, but it's a gnat, in my opinion, in the overall scheme of things. If you hold it for 7 years or 10 years or longer, historically, you're going to see the traditional appreciation and you're going to see a certain amount of rent growth. It's what you're getting into day one, and do you have cash flow on it becomes critical.
Makes complete sense. Eric, if you could throw up that last question, as we're slowly but surely here running out of time. Don, I want to follow up because I think it's so important today in an environment that has changed due to the pandemic, that investors really be mindful of what has changed from a management perspective, especially those investors today that maybe aren't using professional managers. Maybe you could just give some tips today of what investors should be thinking about from a management perspective, whether they're managing their own portfolio or using services on a more formal basis.
Yeah, I think COVID has forced this remote aspect of doing a lot of things virtually. And we were, from a technology standpoint, a lot of these make sense. So if you look at the stakeholders here, you've got the new tenant and the tenant that's in place. You've got the owner of the property that we cater to, and then there are vendors that service and repair the property. So the idea is to connect all of these people into some sort of a virtual network that makes for quicker execution in a remote environment, that I don't have to show up every time, right? So when I'm getting a tenant in there, I've got remote showings, they've got electronic locks, I take their drive, I have a 3D virtual tour that they can look at remotely, right? So these are things that everybody doesn't always have to have somebody showing them the house. They give us the driver's license and a couple of other IDs, and we validate them. There's a lock that they go and use them. So the electronic part of that makes it much easier for remote showings and getting people to see properties on their own time, scheduling it and going out. Now, once you're in the property, we provide a resident portal. So, you can make your payments through that. We collect 98% of our payments electronically, so owners get paid quicker, right? So you don't have to go somewhere, you don't have to mail a check, you don't have to go to your local Walmart. You can if you want. Those options are there, but ideally, we're trying to do an electronic transfer on assets. The other one is scheduling repairs. We have a owner portal, a resident portal where they can schedule maintenance repairs. They can upload pictures. So it's a much quicker, and then there's a vendor portal where the resident and the vendor can directly communicate and say, I need my plumbing done on this date. Are you available? So it gets everybody in the same sort of in the same playing ground for much quicker execution. We find that if there's an 80% reduction in time to resolve some of these issues, which makes that resident happier and stickier. So, and then finally, the owner has an owner portal through which they can track the real-time performance of their property, submit their requests, get information, and they don't have to pick up the phone and call and say, hey, what's my property doing? Did it get rented over here? What's that expense about? So there are escalation points we have for expenses and other things when it gets above it, but within a certain basket, a lot of this is electronic and very seamless. So we've had the fortune of raising a lot of money, so we put a ton of money into technology to do this. So a smaller local property manager will rely more on people running up and down, which in the COVID world makes it a little bit more difficult. And even in a non-COVID world, you do want to be able to do this more efficiently, and where you can do it with technology, but always have the person present. That's kind of the best way to go, and that's what we do.
Yeah, it makes a ton of sense. So we've reached the top of the hour. I at least want to get one question in here, and there's been a couple of questions with this similar theme, which isn't surprising in today's extremely competitive market, which is how are we acquiring equity in properties today that makes sense? And, you know, they sent this to you, Mahesh. You know, how are you buying right, and what can you tell investors today, maybe aside from, you know, making renovations, just straight up buying the property right? Maybe a few tips, and then we'll wrap it up from there.
I mean, it's a hard question and an easy question at the same time, right? I mean, I think my first recommendation is you have to be absolutely disciplined. You know, don't let temptation get in the way of a deal, right? You know, because every time we are looking at something, we all want to buy everything that we look at, right? I mean, it's obvious, right? And we all entrepreneurs, and we want to get the portfolio, and the bigger the better. But I think discipline is the most important criteria. Define the box that you want to invest in and stay true to the box. And if you want to fix the box, go back and challenge yourself and say, why are you changing the premise that you had originally? So I think a lot of people go in thinking they watch HGTV and think this is a good deal to do, and that is not the way to do it. You have to write it down. You have to define, okay, what is it? Am I looking for cash flow? Or am I looking for appreciation? If you look for appreciation, then define the amount of money you're going to put in from your pocket to make the cash flow work, right? I think discipline is the most important criteria, and having be anal oriented, retentive to the point of, if it doesn't meet my box, I ain't going to do it. If you have that discipline, you'll be successful. I think discipline is a key word that I use all the time in my organization. Stay true to what you believe in, and just make sure that you execute to that plan.
Yeah, it's really well said. And folks, what a panel today. I can't believe the hour has gone by so fast. So much great content for our listeners today. Mahesh, thank you again. Michael, outstanding job. What you've been able to accomplish there at SFRhub is truly amazing. It's such a challenging environment for property aggregators today. So well done. Scott, thanks for all the great tips. 1031, let's keep that money working for us. Chris, thanks so much on the financing leverage front. Investors today putting their money to work through the products that you're offering at RCN. And of course, Don, at the end of the day, once we aggregate these homes, if we don't manage them, what's it worth? And your comments today were so well thought out. Thanks to everybody, and we look forward to seeing you all again very, very soon. Good day, everyone.
Thank you. Okay, bye.
Bye.